Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section D. This is an application topic. Calculate the gross property, plant, and equipment balances and prepare journal entries. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to superfastcpa.com and check out our free 1-hour webinar training. Make sure you sign up for that, because we will teach you the key ingredients to passing the CPA exam. Things like, again, studying the questions first, studying in the morning, going back and reviewing what you've learned every day, things like that. We will teach you, and of course other things, to make sure that you know how to pass the CPA exam without wasting months or even years of your time. And on that note, just letting you know, we will only be going over 5 questions in today's video, but SuperfastCPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this, if you like the webinar, if you like our other products, make sure you become a SuperfastCPA Pro member, and you will get access to a whole bunch of resources. Again, among those is the full versions of these videos where we go over 10 questions to make sure that you can get extra practice and extra understanding. So with all that said, let's dive straight into the questions. All right, here we are at question 1, and something you may have noticed if you go and look at that blueprint topic. In the normal blueprint topic, it talks about gross and net property, plant, and equipment, but we're going to be doing a video just on the gross value of property, plant, and equipment. And then the next video, I'm going to be going over how to calculate the net value of property, plant, and equipment and the things that come with that, like depreciation. But in this video, we're just learning about how to figure out how much of property, plant, and equipment is going to be capitalized, and then we'll talk about capitalizing it in the next video. So let's go into question 1. Something we always like to point out is reading the last part of the question first. What is the total capitalized cost of the land? Now, that may not always give you a head start or give you everything you need to know, but a lot of times, just reading that last part of the question will give you a lot of context so that as you're reading through the rest of the question, you can know what is important and what is not. So let's go up to the top here. A company purchased a plot of land for $500,000. The company incurred the following costs: $20,000 for demolishing an old building on the land, $10,000 for legal fees associated with the purchase, $5,000 in property taxes accrued before purchase, $15,000 for grading the land, and $30,000 for landscaping after the land was ready for use. Okay, so with all that information, we have to figure out the cost of the land that's going to be capitalized. Basically, what we're asking with this is we're asking how much is the land going to be recorded as in the books. So if you know how to do this, I think you could probably figure out most of what you need to do here. Go ahead and pause the video and do the calculation. If not, that's okay. We're going to go into this to talk about how to add up all the costs of the land so you know how much it's going to be on the books. All right, here we are at the answer. The answer is B, $550,000. What this question is really meaning is, how much is the land going to be worth on the books? How much is this asset going to be worth on the books, considering all the costs that went into getting it and getting it ready? So the capitalized cost of the land includes all expenditures necessary to get the land ready for its intended use. This includes, of course, the purchase price. It includes the demolition of the old building because you had to get rid of that to be able to use the land. It includes the legal fees that came along with purchasing the land, grading the land, and then property taxes accrued before purchases. This is something that I struggled with for a while because in my head I was like, oh, property taxes is something that's pretty much kind of separate from a lot of things when it comes to accounting. But in this case, these are the property taxes that were accrued before you even were able to use the land. So these were the taxes that you had to pay to be able to even have the land. So it makes sense that they would be part of the capitalized cost or the total cost, the gross value of the land on your books. So property taxes accrued before purchases is going to be included. Now the landscaping was $30,000. That's not going to be included in the capitalized cost of the land because landscaping was considered an improvement after the land is ready to use. So after they purchased it, after they already own it and they're ready to use it, then they did some land improvement. And that is not going to be part of the capitalized cost because, again, they've already figured out the total gross value of the land and it's on the books, and then they were doing the improvement on the land. So that's kind of how you're looking at it there. So the total cost and the total capitalized amount, the gross value, however you want to look at it, is $500,000 plus $20,000 plus $10,000 plus $15,000 plus $5,000 is $550,000. So as you can see, it's not too difficult. You basically just have to think, what are the things that are actually going into this land or this building or this equipment being usable? And that will be a part of the gross value on the books. Let's go to the next question. All right, here we are at question 2. What is the total capitalized cost of the building? Okay, so this is a building. A company purchased a building for $1,200,000. The following additional costs were incurred: $30,000 for roof repairs, $15,000 for installing new electric wiring, $20,000 for demolishing part of the interior structure, and the company salvaged $5,000 worth of materials from the demolition, which were sold for cash. So again, pretty easy, pretty straightforward, very similar to the previous question. Really, the only thing that's being thrown in that we haven't talked about yet is how you treat salvaged materials. But I bet that you could think through this and know how much the gross value of the building is going to be. So pause the video if you need to, think through this, and when you're ready to come back, we'll look at the answer together. All right, the answer is A, $1,260,000 is how much it's going to be on the books. That's the gross value. So the capitalized cost, the amount that's going to be capitalized once you start depreciating it, is going to be the purchase price plus the roof repairs, because you had to repair the roof to be able to even use the building. The electrical wiring installation, again, you had to fix up the wiring to be able to even use the building. Demolition costs, you had to break down some things to be able to use it the way you wanted it to. And then this $5,000 from the salvaged materials is actually subtracted from the total capitalized cost, as it represents a recovery of part of the demolition expense. So they're getting money back from how much they spent on the demolition. That's basically how you're looking at it. So you take all that, pretty much everything was included there, $1,200,000 plus $30,000 plus $15,000 plus $20,000 less the $5,000 that was salvaged, and that gets you $1,260,000 as the capitalized cost for the building. So that's the amount that's going to be depreciated on the books from here on out. And again, we're going to talk about depreciation and those kinds of things in the next video. Let's go to the next question. All right, here we are at question 3. What amount of the total purchase price should be apportioned to the land, the building, and the equipment for capitalization purposes? Okay, apportionment, we haven't talked about that yet. Let's go up to the top here. A company purchased land, a building, and equipment in a lump sum transaction for $3 million. The appraised fair values of each asset are as follows: land, $900,000, building, $1,800,000, equipment, $600,000. So again, knowing that and knowing how much they purchased all that for, we have to figure out how much is going to be apportioned to each of them as far as depreciation, as far as capitalization on the books. So think about this. You probably could figure it out just based off of kind of some intuition, some logic. But if you don't know how to do this, that's okay. If you want to try on your own, pause the video and come back when you're ready. If not, let's go ahead and look at the answer right now. All right, here we are. The answer is A. The land would be worth $818,181, building $1,636,364, and the equipment $545,455. So let's walk through this. It's not too difficult once you understand what it's even asking. So when a company purchases multiple assets in a lump sum transaction, the total purchase price must be allocated to each asset based on their proportionate fair values. The proportionate share of each asset is calculated by dividing the fair value of each asset by the total fair value of all the assets, then multiplying the result by the total purchase price. So that might be a little bit hard to follow in the explanation, so let's go through it here. So first we have to calculate the total fair value. So everything that was purchased for $3 million, what's the actual fair value of all those things that were purchased? So the land, $900,000, plus the building that was worth $1,800,000 and the equipment that was worth $600,000, that actually gets you $3,300,000 worth or fair value of all of that was purchased. So they purchased it for $3 million, but it was worth $3,300,000. So based off of that, we have to allocate how much of that purchase price is actually going to go to each asset so that we can know how much to capitalize for each asset. So the land was $900,000 of the $3,300,000. So we take that percentage that you calculate there and you multiply it by $3 million, and that gets you $818,181 of the $3 million is going to be apportioned to the land. Now, if you did this with the calculator, this technically was $818,181.81. So I would have probably rounded that up to $82. But as I was going through this and rounding, each of these needed to be rounded. And if you round all of them, then you get $3,001,001 instead of the actual $3 million. So this one we didn't round. You would do this kind of thing in normal accounting as well. You don't want to overdo it by that extra dollar. So you'd kind of just be the judge of this. But in this question, that's how we did it. So $818,181. This one was not rounded, even though it probably could have been. The building was $1,800,000 of the $3,300,000, and you multiply that by 3 million, and that gets you $1,636,364, and that's rounded up from that 63 cents there. And then the equipment was $600,000 of the $3,300,000 fair value, and you multiply that percentage by the $3 million, and that gets you $545,455. And again, that's rounded from this 54 cents here. So when you add all these up together, you get the full purchase price of $3 million, but now you have the assets correctly apportioned to that $3 million purchase price instead of their original fair value amounts. So these are the amounts that are going to be capitalized from here on out with depreciation or whatever the case may be. Obviously, the land probably won't be depreciated. Now, land could be depleted potentially, but we're not talking about that right now. So that is how you figure out how much of the sale price or the purchase price is going to be apportioned to the assets so that we can capitalize them. So let's go ahead and go to the next question now. All right, here we are at question 4. What is the total amount of interest that should be capitalized and included in the gross value of the office building? Okay, so this is something we haven't talked about before. A company began constructing a new office building on April 1st, year 1. The construction was completed and the building was ready for use on December 31st, year 1. The company incurred the following construction costs over the year. In April, they had $300,000 that they incurred. July 1st, they had $400,000, and October 1st, $200,000. So this is how much they incurred to build. To finance the construction, the company took out a $1 million loan at an interest rate of 8% on April 1st, year 1. So now with all that information, again, we have to figure out how much of the supposed interest throughout this is going to be capitalized as a part of the gross value. So you're going to be able to include some of the interest in the gross value. But honestly, this was something that did not come intuitively to me way back when I was studying. So I wanted to make sure that we covered this and went over it. So let's walk through the answer to show you how this interest is going to be included in the gross value of the office building. All right, here we are. The answer is C. $38,000 of interest is going to be included or capitalized in the gross value of the building. So let's walk through this. Again, this is something that I would not have thought about until I learned it. So let's read the explanation. To calculate the capitalized interest, we need to use the weighted average of the accumulated construction expenditures over the time period the funds were used. So apparently we have to focus on how much they spent on the construction to be able to figure out the capitalized interest. So let's walk through this. Step 1, calculate the weighted average accumulated expenditures. So we have to take each of these expenditures and see how long they were outstanding throughout the year, and that will let us know how much of each of these expenditures is going to be included in the weighted average of the total expenditures throughout the year. So on April 1st, they had $300,000. Now that was outstanding for 9 months because April to December is 9 months, and it was completed in December. Weighted expenditure was $300,000 multiplied by that 9 divided by 12. And so that's $225,000 of this April 1st, $300,000 is going to be part of the weighted average. Now for July 1st, there was $400,000. It was outstanding for 6 months from July to December. If you multiply 6 divided by 12, because that's how many months of the year it was outstanding, by the $400,000, that gives you, obviously that's 50%. So that's $200,000 of this July 1st expenditure. And then the October 1st expenditure was $200,000. That was only outstanding for 3 months. So you multiply by 25%, 3 divided by 12 is 25%. So $200,000 multiplied by 25% is $50,000. So that's how you get the weighted average for the expenditures, because you add all that up together and that gives you $475,000. Now, why did we do that? We take this $475,000 and we can multiply it by the interest expense or the interest rate for the loan that was taken out to be able to do this construction. So $475,000 multiplied by 8% is $38,000. So $38,000 of interest is how much we can capitalize or include in the gross value of the building to be capitalized. Now, to be honest, it's a little bit strange to me that this is the way that it's done, but that is how you do it. Now, there is one thing that you need to pay attention to whenever you see a situation like this, though. You do have to pay attention to how much interest the total loan is going to have over the course of the loan. So since the interest on the loan amount was $1 million multiplied by 8%, that's $80,000. So $80,000 of interest is going to be how much interest there is over the course of the loan. Since this amount is more than sufficient to cover the interest calculated on the weighted average expenditures, the full interest on the weighted average expenditures is capitalized. Therefore, the total amount of interest to be capitalized and included in the gross value of the building is $38,000. Now, again, let me talk about that a little bit more. This $80,000 over the course of the loan, if for some reason the interest from the weighted average expenditures was actually greater than the total interest that comes from the loan, so if for some reason this $38,000 was actually $90,000, you actually can't go over the total interest from the life of the loan, from any loans that are used to do the construction of the project. So it can't go over this $80,000. Now, in this case, obviously it was well below that $80,000, so you can capitalize that full amount of interest from the weighted average expenditures, and that again is going to be added to the gross value of the building, and that's going to be capitalized over time. We're going to talk about that in the next video about, depreciation. Kind of a strange rule there, kind of a strange way to think about it. And one thing I also want to point out is that this is one of the ways you can calculate this. I think this is the much easier way. Technically, you can also take $300,000 and only multiply it by how long that was outstanding. So until the next expenditure. So April 1st, so April, May, June, that's how long this was outstanding by itself. So one of the ways you could do it is do $300,000 multiplied by 3 divided by 12. And then in July, you add $400,000 to the $300,000, giving you $700,000. And that's outstanding from July, August, September. So that's another 3 out of 12 months. So you do $700,000 multiplied by 3 out of 12. And then October was outstanding for the remaining 3 months, but you add $200,000. So it's $900,000 multiplied by 3 divided by 12. If that confused you, that makes sense, because honestly, I think that's a much more difficult way to do it. I think it makes way more sense to just take each expenditure by itself, multiply it by how many months it was outstanding throughout the year, and then add them all up together, and that will give you the weighted average, instead of adding it all together and only taking into account how long that specific total was there for the month, like only taking those months into account. Again, it's confusing, so I think this is the better way to do it. Anyway, now that we've talked about how to capitalize interest, let's go to the next question to talk about it a little bit more. All right, here we are at question 5. What is the total amount of interest that should be capitalized and included in the gross value of the retail facility? Now, this question is very similar to the previous question. It's a little bit different, so you might have to think about it in a slightly different way. And I'm going to teach you one more rule about this if you don't take it into account yourself. But let's read through it. And again, I think you can, and again, this is very similar to the previous question, so I'm expecting you to probably do it on your own. A company began constructing a new retail facility on March 1st, year 1. The construction was completed on October 31st, year 1, but the facility was not placed into service until December 31st, year 1. The company incurred the following construction costs during year 1. So they had, on March 1st, they had $400,000. On June 1st, they had $300,000. On September 1st, $200,000. So these were their expenditures throughout the process. To finance the construction, the company took out a $500,000 loan at an interest rate of 9% on March 1st, year 1. So with that information, again, very similar to the previous question. Try to figure this out, think through it, come back when you're ready, and we'll talk about it. All right, here we are. The answer is D. $38,250 is the amount of interest that can be capitalized. All right, let's read through the explanation. To calculate the capitalized interest, we need to use the weighted average of the accumulated construction expenditures for the period the project was in progress. That's important right there. Only for the period the project was in progress, which ends when construction is completed on October 31st. Interest cannot be capitalized for the period after completion, even though the facility was not placed into service until December 31st. So that's important to note. You can only capitalize interest during the construction of a project. So even if there's more interest because the loan still exists, even if there's more interest after the construction is completed, that interest after the construction is completed cannot be capitalized. So that's important to note. Step 1, we have to calculate the weighted average expenditures. So we know how to do that. We did that in the previous question. Let's scroll down so we can see all of it at the same time. We have the March expenditure, $400,000. That was outstanding from March to October. That's 8 months. So that's $266,667 from multiplying it by 8 divided by 12. Then the June 1st expenditure, $300,000. That was outstanding for 5 months from June to October. So that's $125,000 instead of the $300,000 when you multiply it by the 5 divided by 12. And then the September 1st expenditure was $200,000. That was only outstanding September, October, only 2 months. So 2 divided by 12, and then you multiply that by 200,000. That gives you $33,333. So we add all that up together, and that gives us $425,000 of weighted average expenditures. And we use that number to multiply it by the interest rate that was given, 9%, and that gives us $38,250. Now again, like I talked about in the previous question, you always want to make sure that for some reason the loan interest isn't lower than the capitalized interest that you calculated. So the loan interest is $500,000 multiplied by 9%, that's $45,000. Over the course of the loan, it's going to be that amount of interest. So since the capitalized interest does not exceed the loan or the loan life interest, then you can use that full capitalized interest and add it to the gross value of the thing that's being constructed. So we talked about a lot of different things in this video. Before we go any further, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 3, 4, 5 questions trying to teach you how to capitalize interest, and you've seen 3 or 4 questions trying to teach you what costs go into the gross value of land or a building or whatever the case may be. You've seen these things throughout multiple questions, so you know that they are important. You know they are a key topic or a pillar topic for the exam. So you take a moment, You write it out in your own words. You kind of summarize what you learned, what are the most important things from the questions. And as you do that each day, you're going to be slowly gathering the most important things from the multiple choice questions and going straight to what is most important. Instead of having to read through an entire textbook and not knowing what is actually important, the questions will inform you what is actually useful and is needed for the exam. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Again, this is kind of just a summary in your own words of what the most important things were from the questions. This is in my own words, so it might be different for you. Typical costs added to property, plant, and equipment. The expenditures directly related to bringing an asset to its intended use, such as the purchase price, the legal fees, the demolition costs, site preparation, there's a whole bunch of different things that go into it. They are included in the gross amount of property, plant, and equipment, or PP&E. So any costs that you have to incur to get an asset to its intended use typically are included in the gross value of the asset so that you can start capitalizing it. As far as lump sum purchases, again, that is where you would do something called apportionment. When a lump sum purchase includes multiple assets, such as multiple pieces of land or multiple buildings or multiple pieces of equipment or a mix of those, the total cost is apportioned based on the fair value of each asset. This ensures the costs are allocated proportionally and capitalized correctly for future depreciation. Remember, you add up the total fair value of all the assets, you divide the fair value of one asset by the total fair value of all the assets, and you multiply that percentage by the purchase price, and that will tell you how much is apportioned to that specific asset out of the purchase price. Now, as far as capitalized interest on construction, this is something that can be added to the gross value. Interest incurred during the construction of an asset can be capitalized as part of its gross value, but only while the asset is being constructed or developed. Capitalized interest is based on the weighted average accumulated expenditures over the construction period, specifically only over the construction period, and we're going to talk about that right here. Limits on capitalized interest. The amount of capitalized interest cannot exceed the total interest incurred on loans used to finance the construction. Additionally, once the construction is complete, interest incurred after the completion date is expensed rather than capitalized. So you can't capitalize interest on the loan after the construction is complete. So the loan's still going to be there. You're still going to be having interest that is coming from the loan that you have to pay, but you can no longer capitalize it once the construction is complete. So we talked about a whole bunch of different things there. That was how to calculate, or some of the key things that you need to know for calculating the gross value of property, plant, and equipment. Again, in the next video, we're going to be talking about how to calculate the net value, things like including depreciation or amortization or whatever the case may be. We're going to talk about that in the next video. With all that said, that is the end of the video. And before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, we will teach you the key ingredients to passing the CPA exam for free in just 1 hour. And of course, you're going to like it so much that you're going to want to look into our other products. So make sure you become a pro member and you will get access to the full 10-question videos that I make after I make these 5-question videos that we post on YouTube. So again, you can get access to the full 10-question videos and a whole bunch of other resources by becoming a SuperfastCPA CPA Pro member. Make sure you do that. Make sure you check out the free 1-hour webinar. Also, if you like the video and you like what we're doing, make sure to leave a like and a comment on the video. And with all that said, thanks for watching. I hope this was helpful, and I will see you in the next video.